I bought it as a present for my girlfriend. And I think moat has this significance because it's something between me and her. So I also want our relationship to have that kind of moat to withstand challenges and the tribulations in times to come. Due to the correction, some of the stocks that I had in my portfolio, they suffered some corrections and the margins threshold was actually triggered. So I lost back most of the option premiums I wrote. So
Alright friends, welcome back to the channel. Today I have invited my friends Joo Parn to the channel, and this is the first time Joo Parn show up in the channel, and we will do an interview similar to the one that I had with James. Welcome to the channel, Joo Parn.
Thank you for having me, Bunti.
Let's kickstart with just talking about yourself first, because I think among maybe Singaporean viewers, right, maybe you are not that active yet. So maybe you can just introduce yourself.
My name is Joo Parn. I usually go by the name JP if you think my name is hard to pronounce. I came over to Singapore for career reasons, I think close to 7 years ago. And it was also kind of the period where I started off MyKayaPlus.com. So it was, or it is still a website that is investing centric and sometimes a little bit of financial planning kind of aspects to it as well, but mostly towards stock analysis and also having my own thoughts penned down. It started off as a website dedicated to Malaysia stocks because that was where my roots are, but eventually coming over to Singapore and having the exposure to look at stocks in listed on the Singapore exchange and also many parts of the world as well. So that was where I also took the channel and the website to further, strides to not only look into stocks within Malaysia, but I think as of the past few years, our core focus has been mainly stocks around the world and also within Singapore as well. So my growth, my development for the past few years for Kaya Plus and everything is like how I, structured and, write it down over the years. So if you can look back to the first article until the current articles, it has been like a log or record of how I have grown over the past few years.
So you have this website called MyKayaPlus. So I'll put the link in the description for those who are interested to read out your writings. You are doing that not just you alone, right? You have a partner, so two of us doing that, right? And then you have a YouTube channel. Of course, the link will be at the description. That is your own personal one, or also you work together with your partner, the same partner, is it?
Yes, it's the same partner. So basically, because it's not easy handling and managing a website and also a YouTube channel, so each of us contribute in any ways that we can. So I am the one who actually does most of the writing, the analysis. So the number crunching part, if you use the thesis, always comes from me most of the time. And for my partner, he is usually in charge of scheduling posts, maintaining the website, and whatever financial related expenses, all the nitty-gritty part from an operating point of view, not from a content point of view, it will be handled by my partner. Yeah.
Okay. So two of you, okay, he's basically your CFO and your COO, and you are the Chief Investment Officer. You can.
Yeah. So maybe you can also call him the CEO as well. I'm just a CIO.
Okay, so why do you choose to work with a partner and not like just doing it all on your own?
I think he was the one who actually initiated this. Back then, when I became very engrossed into investing, I would just do my own homework and I would just share across group WhatsApp. And he just found that okay. And back then, he also didn't have a basic knowledge of investing, but he did find some sort of logical common sense the way I approach things. And he was like, have you ever thought about, setting a website up and, having all of this? Because you have already been doing it, just systematically have a record in any form, be it a YouTube video or even as an article. So to have a website or page to just capture everything. So he initiated it. I found the reason, rationale, and that was where the collaboration came in and started off from there.
I think it's always good to have a partner so that you can, push each other. So that, because sometimes if you are working alone and then sometimes you still have a full-time job, right? And then you get carried away with the full-time job and get No one push you, but if having a partner, okay, there's a responsibility not just towards yourself, but also towards your partner, right? I think that's the motivation partner. Yeah. So let's go into the investing, because I think we met up before and then we chat about investing, but not in very details. So I just curious, like how would you describe your investing style?
Over the years, there have been plenty of categorization or different kinds of investing methodology and style. I think one word that really stick to my mind until today is what mentioned is that you can call yourself a dividend investor, you can call yourself a growth investor, you can call yourself, but at the end of the day, growth and value is joined together at hip, right? So there can be plenty of reasons. Of course, there can still be deep value investing where you look at companies' valuation just from a net point of view. It's trading way below the price to book, and you can come in and argue that this company should not be worth that much. The assets on the company's book is much more valuable, even though a company might not be reporting good financial results. But I think at the end of the day, it's just coming out on a very brief surface and say that I think this company is undervalued, be it from a valuation point of view, net assets, or be it from the future growth prospects. And you come in and say that I think the company is undervalued. I want to, take a stand and, make a punt, or even come out with a thesis and say that the company should be worth more, say 3, 5, 10, 20 years down the road. And that is where I think the very basic analogy of how we speak and categorize different kinds of investing theses or different kinds of methodologies. At the end of the day, we think something is undervalued or we think something is overvalued. We touch it, hold it, or we don't touch it, and we wait for value to resurface.
Can you name 1 or 2 examples among your main holdings now, just to help people understand your approach when it comes to investing?
I think it's easy to name some of the components of Magnificent Seven. So most of the holdings that I have that are components of Magnificent Seven, they have been very good companies, even from the point when I started analyzing them. Like say, for example, Microsoft, it has been a very stable tech company. I mean, it traces its roots back then by just having the goal of putting computers into every American household and eventually every household around the world. But throughout the years, evolving to not just doing that, but to also providing tip-top office suites products that help with productivity, and eventually also going down the cloud path where it eventually becomes the top 3 cloud service providers around the world. So there is always an evolve in the business prospects and also how they are, eventually changing and charting the cost. So we are not now talking about Microsoft. Back then, 5 years ago, it wasn't about AI, but now the company is, stepping forward to also do something about AI, and we know that AI is going to play some sort of importance for the next 5, 10, or even 20 years down the road. So that is how you can, add back and look back at what the company has done past 5 years, current years, and and try to project what the company can contribute to mankind the next few years down the road as well. Yeah.
So you have Microsoft in your portfolio for how long already?
I think since COVID. Yeah. So COVID was the time where I really started to invest in the US. So valuations were good. It was also, I think it was just the right time where I was looking at Singapore first, and then when COVID struck, I just look into US stocks. There was so many time stuck at home. Yeah, eventually just making good use of the available time, and that was where I just found out that wow, companies listed in the US are a different kind of animal compared to what we have in Singapore and also what we have in Malaysia.
Yeah. So let's take a step back, right? Because you mentioned you started out from Malaysia and then moved to Singapore, study Singapore stocks, then US as well. So how do you allocate this different geography? Do you have a top-down kind of thing, say, I will have 1/3 in each of this market, or how will you do that allocations partner?
That's a good question. So when I started off investing back then in Malaysia, it was just no-brainer. Everything just chucked into whatever good companies that is available in Malaysia. But when I found out that, coming to Singapore, and if you want to look at dividend investing, then you start to realize that, hey, how come the REITs listed in SGX is at a much better quality compared to the Malaysia one? Same goes to the banks as well. And slowly, when you have available capital on hand, if you're looking to deploy capital, you would do a very straightforward comparison. Okay, I have money on hand, I'm going to buy something. I want to buy a financial component of a bank to complement my current portfolio. And these are the available options, like OCBC, UOB, EBS, and your Maybank, CIMB, etc. And you want to buy the best, right? We don't go into the market to buy mediocre companies. We want to buy the best companies because hard-earned money, you will need to make your fund, or you need to ensure your investment spend. So that is the moment where I realized that, hey, I'm not actually allocating a lot of stuff back to Malaysia. In fact, I think I stopped buying Malaysia stocks. All I have right now is just what I have accumulated back then throughout the years, and I stopped, allocating capital into my Malaysia holdings. I'm even thinking of trimming them down in times to come. And that was where I realized that, it's always about choosing and picking the best businesses available out there at fair value. And that is where I also realized that the same process pans out when I look at, stocks available in the US, Hong Kong, China, and then coming back into Singapore and say, hey, I think this company is going to be, performing in a much better pace compared to Singapore REITs or Singapore banks. And that is also where the second, learning curve occurs.
Can I summarize that? Okay, from Malaysia to Singapore, you notice that Singapore REITs and banks are better.
Yes,
and then
definitely.
From Singapore, when you look at US, you are thinking that, wow, US is even better.
Yes.
Okay, if that's the case, right, can you share, like, maybe not the exact details, right, but just roughly speaking, how many percent is in US versus Singapore versus Malaysia right now?
Yeah, that's a very good question. I actually anticipated that would come out. So currently, 40% is US, and Singapore 30%. So I still find some potential picks in Singapore that are worthy long-term holdings. So that's why you can say that US is just slightly ahead compared to Singapore. So 40% US, 30% Singapore. And Malaysia is just down to 13. So bear in mind, when it started, it was 100% Malaysia. So it's now just 13%. Hong Kong, China also around 13-14%. And then the balance would be in other parts of the world.
Why not you also realize that US is a lot better, right? Why not you just, clean up everything, just hood into US market, and because it's superior, right, in terms of business, based on your assessment, not mine.
Definitely, but I think each market has its own value proposition. So when it comes to growth, when it comes to holding companies 10, 20 years down the road for compounded share price movements, definitely the US is a no-brainer. But I think deep down inside, I also realized there is place for companies that pays good dividend, pays good passive income. And I think that is where Singapore comes in to offer better value proposition, because companies in the US, even though they pay very good dividends, if you're an alien, you get subjected to the 30% withholding tax. You can argue that some companies, 20, 30 years down the road, if the business continues to grow, the dividends payout minus of 30% withholding tax could still be a very good payout when you reach, your retirement age. But I think some of the companies right here in Singapore, with no concerns with regards to the withholding tax, they're actually already paying very good, dividends, and the yield is just very decent. And I think risk is very manageable from that point of view.
I think from tax perspective, starting out from Singapore is really a good place. Okay, dividends, it is small, especially if you are talking about owning all these tech stocks, right? Their dividend yield is not that high anyway. So unless you really focus on US REIT, then that could be a concern. And then the other thing is that even for the US resident, they have to pay capital gain tax whenever they sell. We don't have to pay that. So we are actually even more advantage, more advantage as compared to our US investor counterpart. I think that's interesting. They will envy us, I think.
I think it's we both get the best of the worlds that each and everyone wants. So I think the US investor are envy of us because we don't get a capital gains tax, but we also envy of them because they don't get the dividend withholding tax.
Yeah. So actually, I want to ask you, like, now you have exposed to different markets, right? US, Hong Kong, Malaysia, Singapore. How do you look at currency? Because we always invest with the mindset of like I want to own the company, but sometimes the currency is the part that we don't like. It's something that it's quite hard to get rid of, because like you put your money into US. Let's say the company is doing well, but USD drop up as Fed cut interest rate, right? That could be a concern. And then for those who want to put money into Malaysia, even so, right? If you look at the chart of ringgit versus Sing, that could eat into your returns if ringgit depreciate now. So how do you look at this angle?
A lot of people do look into it. I think personally, I do also give it some sort of consideration. How I actually justify, it's not just what is the current rate and what is the future rate 3-4 months down the road, but I tend to look at things at a longer horizon. Yes, there are going to be times where Sing dollar is going to be stronger than US dollar. So I think for the past few months ago, that was the case. But there are also going to be times where the US dollar is a much stronger currency compared to the other currencies that we have out there. And if you were to look at stable currencies in the sense of USD versus Sing dollar for the past 10 years, yes, there's a range, but it's not going to be a slope or trend where we see US dollar significantly strengthen or the Sing dollar significantly strengthen. From that aspect, if the currency does trade within a range and you're comfortable within that range, I think the currency risk usually won't play a significant or huge part in terms of whether you want to own a company or not. Conversely, if we talk about ringgit, there is a significant trend of depreciation of ringgit against other major currencies. And that would actually play an important part, or I would say take center stage when it comes to projecting how much this company is going to be worth, even though it's a good business. But since everything is reported in ringgit, you might actually not see significant gains 10, 20 years down the road because of the depreciation of the ringgit. So I think case to case, usually stable currencies, they do trade within a certain range. And if it's not a significant change in terms of the country's macroeconomic environment or their monetary policy, I think we should take still that with just a pinch of salt, because currency is a risk, so is the company's business model, right? So I think it's just balancing out and try to look at things at a bigger and longer horizon rather than just get fixated at the near-term fluctuations.
Okay. Maybe just a short-term trade as noise, but long-term need to account that in your valuations. For example, Malaysia, you might want to increase your discount rate, right? Just to
yes, definitely. Yeah. And really need to think twice whether you are comfortable in a currency or a company's reporting currency that is has a very clear track record of depreciation against other currencies. Yeah.
Just curious, right? Do you like put your money all into all these different individual stocks, or do you also have some passive instrument, for example, like ETF, just to get broad exposure kind of investment?
I do. I think I started a little bit of ETFs and also a little bit on passive investing. So I do have a small portfolio with Stashaway. Mm-hmm. So by the way, it's not sponsored, but back then when I was just starting to learn investing, I wanted to see if it is possible to track or even outperform robo-advisors. So I set like a small amount, it's a monthly gyro thing, and I'll monitor the performance against mine. And I think last year also was where I started at another holding or another position in MOAT ETF, MOAT. So I bought it as a present for my girlfriend. So she does not have any investing in terms of stocks, but I think that it is good to start something. And I bought a few lots of MOAT ETF for her. It's still in the portfolio, and of course I want to make it something as an annual thing. So every time we pass 1 year, I'll buy more and buy more. And we want to see how things compound, let's say 5-10 years down the road.
So that MOAT ETF, is it sitting on your brokerage or her brokerage account?
It's sitting on my brokerage account. Because she don't have a brokerage account, but I'll share with her, okay, this is how the ETF has been performing. This is the unrealized gain, etc. Yeah.
So she have no interest at all, like just open the account herself, and then so that you can put some money into that account. So she don't want to touch all this at all. Is it?
Yeah. So I think some people, or most people, they just want to, she's not someone who wants to get that has an interest But I think most of people that we know, maybe our friends, families, relatives, they know the stock market is a place to, profit if you done your homework right and you pick the right stocks. But for them, it's just about the end goal. I just want to earn money. But how much I will earn or how much I could possibly lose, they don't have any, indication or back knowledge about it. And they just buy in the hopes that market will go up, rather than, yes, I think the market can go up by 30%, 40%, 50% by this period, but I also must also be wary that if theses don't pan out, then what could be the potential downside. So this is where I come in and say that, yeah, I think it's worth to kickstart something. But since you don't have any initiative or intention or even passion, well, let me do it for you because I have it.
I thought that there's already carrot there, if you do some work, open the account, and then you put the money in. If no, then you don't put the money in. So at least there's some incentive to put things on her hands so that she's more invested, not in the sense of her money, it's more in the sense of the energy, because now it's all under her account, right? So buy sell also she have to do it herself. So I think that can help to kickstart the journey.
I think maybe it's just going to be a step by step. So it's just proving to her that you see really can earn money if you do homework well and you put a little bit of effort. Yeah. Perhaps that would become the incentive, let's say, for the next time when she decides to take things a bit more serious.
Yeah. So can you just share, let's say, when you update her in terms of the performance, in terms of the how is doing with the account, right? What is she most interested about? Like is she just interested about the stake worth how much, or is it like talking about the return? What is she most interested about?
I think she's also not much excited or concerned. It's just that from a very layman point of view, something as passive as having an ETF that tracks certain sectors or even have a mandate to what to invest. But at a very surface value, if I were to talk to someone about ETF, you buy an index, say for example the SPY, that tracks the S&P 500. And during good times, right, you can even see 10, 11-ish%, right? It's not going to be doing that every year, but I think we have had a good year. And that is where we have seen, even the broad-based index to chart in around low double digits returns. And that is already much more lucrative to say your unit trust, much more higher than say your dividend yield from your blue chip banks. So I think when people look back and think and see and compare returns, you be like, wow, this is actually a good investment because first, it's diversified and it has the track record or the potential to provide a return that I would say that not all funds out there, or not all mutual funds, unit trusts are able to promise and even to provide you that kind of returns. Because what you buy and hold on an index, if it's 11%, yes, there will be some management fees, but after you net that off, you'll still be holding on the gains. Whereas compared to other traditional funds, they might just declare a percentage of dividend payout, but they will come in and support and buffer future returns if the market is not performing. So I think it really depends on how you want your returns to be recorded and how you want, to look at your returns when you look back and see what vehicles of choice that you have chosen to invest in.
You mentioned S&P. Why not you just buy the S&P for her, and why choose another specific ETF?
One of the reasons I think I chose more was the fact that I like the approach, because I know that from my portfolio point of view, if you were to look at it as a totality, I'm heavy already on Magnificent 7 in my portfolio, right? So I think buying S&P 500 would further concentrate that. And when I look at Moo's, product, their, product offerings, their documents, they have had some sort of good track record in terms of providing good returns historically, but not having too much or too huge of an exposure into Magnificent 7. So I find that very complementing to my overall top portfolio, because I've still used my portfolio to buy the ETF for her. And at the end of the day, I still look at it as something that we are managing and holding. So I don't want to necessarily add on another potential component that would further concentrate something that I don't want to concentrate at the time of the being. So, and I think mode has this significance because it's called mode, and because it's something between me and her. So I also want our relationship to have that kind of mode to withstand, the challenges and the tribulations in times to come. So it just felt very you can say it's cliche, you can say it's punt, but yeah, I just think that everything just fell into place well, and that's where I took the decision to buy modes and make it an ETF holding inside the portfolio.
Yeah, I thought usually, let's say when a guy buys some investment for girlfriend or wife, right? Usually they will try to buy, like stocks like LV. So instead of buying LV back, you just buy LV shares, right? I think that one, in terms of the meanings, is a lot more meaningful. But I mean, this ETF, I haven't heard about this mode ETF. Take a look later, but it sounds quite interesting. Okay, so let's switch gear a little bit because I saw that in your MyKayaPlus website, you mentioned that okay, there's this new article that you just published, right? I read out the titles. So it's how should a median or low income earner invest? So I thought that's quite interesting. I read the article, I read the post. It's just that I think I don't fully understand why this post came out, because it seems that you are talking about, okay, if you just invest in a broad ETF, this is so much return that you have. If you are earning low income and you just want to supercharge your returns to meet the higher target, right? Then you need to take on more risk. It sounds like you are talking about like higher risk, higher return kind of things. Maybe you can give me a bit more like background on why are you writing this post? I think quite interesting.
Yeah, I think that post has been in the making after I talked to other friends who are inside and within the financial blogosphere community. From his point of view, he's like, why every now and then there are posts like, here's how you should invest if you have 100,000 or you have 1 million. If you are someone new to the financial blogosphere as a reader, you'll be like, wow, this is something quite useful and quite meaningful, because this person is actually highlighting to me how to actually build a portfolio from scratch. But the title is, if you have 1 million or even 100,000. Things will change, right? This is not going to be the first time you come across such title or such blog post. So let's say the next time you come across a similar title, but from a different writer, right? And the total holdings is totally different, right? So you might come across someone who says, this is how I'm going to allocate 100,000 into 6 REITs. And the other one will be, this is how I'm going to allocate another 100,000 into 6 US stocks. Then you'll be like lost. How come he say these REITs are good and the other one says these 6 US companies are good? So you're going to be lost just because you had money lying around there and you just wanted to craft a basic portfolio. You would get I would say noise, and you would be in a little bit sense you're lost. So my friend was actually quite, can something be more substantial? Can something be more meaningful in a way that we put out a statement out there how people should invest? And I don't think that a lot of people would have 1 million or 100,000 lying out there, and then when they read upon this article, okay, this is how I'm going to follow, and I'm just going to follow what they are buying into these 6-10 companies. And that is where it triggered me to come up with something which has more foundations, which is we are going to be targeting people with median income or low income out there. We're going to tell them, let's say if you don't want to do any stock pickings, you want to just track the broad-based index returns. And with this kind of monthly capital that you're pumping in and you are diligently doing your dollar cost averaging, where are you going to stand and where are you going to achieve that when you reach your retirement age or certain age down the road, right? So of course there's going to be projected returns, and as I said, that is just a very statistical projection. It doesn't take into consideration that a potential meltdown in the financial markets 5-10 years down the road and which particular date. But it gives you a sense that eventually the market will recover and you have a revert back to the mean. And theoretically, by the age of 50, 55, and 60, this is where you should have, or what amount you should have. And are you going to be happy with that amount when you eventually plan for retirement age? So I think that gives and paints a little bit more clarity. And if you know that, let's say by the age of 50 or 55, I had 1 million in my bank account, am I going to enjoy my retirement life? If the answer is yes, then yeah, I think you have actually found the roadmap or the plan to start something right now, diligently do it for the next 30 years, and eventually you arrive at your goal. But let's say on the flip side, if you're something who wants 2 million and doing passive index investing doesn't actually help you achieve your goal of 2 million down the road, then something must be done now, because you don't want to reach a stage where you have reached that age and you found out that you are still very far from your target goal. And I think that makes a little bit more sense because at the end of the day, we are not in the market to go in and out every day. We are going to be in it for a long term. So we have to pick something that provides us the return that we want when we reach a certain age that we decided to call it a day.
Sounds to me it's like this is investing questions, and then it morphed into more like a personal type of discussion, because the key is not about like what to buy, right? The key is to figure out like how much do you need.
You want, yes,
and
definitely.
then only you put in the what to invest, because the what to invest will decide like what kind of risk that you are taking. Because although you mentioned different index there, but maybe I think if we take a step back, it's not like everyone can tolerate 100% kind of allocation into stocks. Maybe the other discussion is how much you want to put into like safer investment, right? Like bond investment and so on. And of course, if you put into bond, maybe it should be that the returns is lower, but if it still meets your financial goal, why not, right? So you actually can journey through this with lower volatility, which is even better, right? So,
yes.
Okay, I think that's quite interesting. But what was the, like, let's say after you share this with your friends, right? And I don't know, like, it all depends on how the person is framing the questions, because the title is saying that, okay, if you starting up with like lower income, right? Let's say you earn like, let's say 4,000, not that fantastic salary, but then after you cut deduct all the expenses, you can only save, let's say 500 or let's say $1,000. You know that this one, even if you diligently save, is still not going to hit like the figures that people aspire to be. For example, like 1 million, 2 million kind of amount, right? So I noticed that this group of people, usually they will tend to be a bit frustrated, because maybe on YouTube they saw people having 3 million portfolio. Even Adam Khoo keep on showing his returns, like 1 year return could be 200,000. People are struggling to get that kind of account because of the saving isn't that huge. So they're frustrated. So how would you like advise, or how would you comfort this group of investors?
Yeah, I think I had a deep thought about it. Like for that article that I put out, I actually link it back to another sub-article that I have on Substack, in the sense that if you really want to achieve your financial goal, and your financial goal right now, based on the projections you have, based on the types of investment methods that you choose, and based on the amount that you can actually save and do diligent DCA, right? You can do a really simple projection. If that projection by the next 20, 30 years does not comes close, then actually you should actually think of increasing your earnings right now, right? It can be upskilling, it can be whatever means, getting a second job, etc., etc. Because at the end of the day, as much as the golden goal of investing, which is to achieve certain financial stability in your life somewhere down the road, it doesn't gives you the right of freedom to not do anything for the sake of it. Yes, you can say that I want to do passive investing, right? That means I want to be as passive as possible. I just throw in money diligently every month, every year, and it will just grow to what I want down the road. Doesn't work that way. So very ironically, the key or the important aspect to achieving what you want to achieve, even though you hate the working schedule, the daily grind of going to work, but you need to know that that is actually going to be the main source of capital, generating income from your work, so that it becomes part of a capital, and that capital you put it to good use and good work, and it only will work when you have everything in control. So higher savings, higher contributions, and also higher returns from the stock market. So that would actually play and accelerate everything. You can't just depend on bullish market movements, bullish runs, and you just put in a few amount and just pray everything pan out nicely and perfectly. Then 20 years down the road, it doesn't work that way. You have to put in the hard work, and then you also let your money put in the hard work as well. So everything comes together to compound and give you the returns that you want by the end of the day.
This I can relate also, because there are friends who know that I produce YouTube content. They will just ask me like, oh, to them it's like it sounded like yes, I have my like active income. I work. I have then at the side I want to use investment as a tool to help me increase the returns. It's almost like asking like, oh, I have few thousand income here, and then how do I generate another like few $1,000s from just investing? So I do think that sometimes it's a bit hard for me to give that kind of answer, because to me it's like actually the investing part isn't to give you income. It's more like you already have your income, you want to store it somewhere, and instead of like, storing in fixed deposit, giving you like low percentage return, it's just a way for you to compound your money faster. But still, that's a tool that you should, build onto that portfolio instead of like thinking that, hey, actually, how do I, generate few thousand? Then if you ask like, how much do you have? Because if you already have like $1 million, just to generate few $1,000s per month, I don't think that's difficult. I mean, just a low returns, you can make it. But let's say you start out with like, I only started with, I have 20,000. Then you want to earn, let's say 5,000 from 20,000 on a monthly basis. That's impossible, right? It's just like you're not there yet. So I think you are trying to, bring the person back to reality. But sometimes I'm just thinking that whether it works or not, because after some discussion, if people realize that, oh, actually you are telling me can't be done, like I still need to work hard. So it's fun, right,
Then you'll be frustrated because you say, I thought stock investing is a way towards financial freedom. It is, but it's not something that will happen overnight. It's not a lottery, right?
Yeah. Unless you are getting into those, GameStop kind of situations. How do you view these GameStop things? People buying, lottery tickets. There are people who strike gold from there. Right? I even have friends who earn a lot from it's like life-changing type of monies from GameStop. Not the recent round, I mean the 2020 or 2021 round. So do you strongly advise against that, or do you feel that that's fine?
I think the right answer to answer that is be prepared to lose what you are willing to put in. Because at the end of the day, yes, I won't deny there will be opportunities, there would be circumstances where we will look at potential GameStop 2.0, 3.0, or even other stocks out there. They would experience, euphoric sentiments where it would just go crazy for a few days or even for a few months. But at the end of the day, if you think that is the way that you are going to change your life and you put in substantial amount, and if things don't pan out the way you want it to be, then you are going to be, looking at a huge loss, right? Say, for example, you put in a whole entire savings to GameStop and think that it would just, triple and quadruple within one night, and then you cash out the next day and you become an instant multi-millionaire. There's a possibility, but what are the chances in terms of statistics? So you need to answer that question, and you need to be fully happy and contented that, okay, I made a wrong choice, I made a wrong decision, and this is the amount I'm willing to lose, and still life goes on. I think it's not worth to let your life take a drastic change and screw up your entire plannings for retirement or even for your child's education just because of greed.
Okay, speaking of that, right, I just want to switch gear a little bit. There are people who think that, okay, with stocks very hard, you probably need to do long-term investing and so on, compound. Every time we talk about this, it's like 20 years, 30 years kind of things. People want result fast, right? And then there's one I would say quite common type of strategy is using options, right? So I'm sure you have heard of people like try to sell some put options, call options, do some fancy strategy on options just to generate income, not so much about like long-term investing. You also written a post on talking about like options trading, right? Maybe are you doing this kind of strategy? Can you break down this on this topic?
So I think I'm started off that because I wanted more capital to eventually deploy when the time is right, and I also view it as something that can increase your savings or your capital and deploy when the time is right. So I started small, then I started to see some results. And then eventually, when you talk about options investing or even writing options to be exact, you're actually doing margining and leveraging on top of your portfolio. So your service provider will come to you and say that, okay, since you want to have a margin account, so this is the amount that I'm willing to give you based on what you have in your account. And you use that margin within your means to do whatever fancy strategy on whatever view that you want. You can buy call, sell call, you can buy put, sell put. So, but you want cash, usually you do sell. You sell options, right? Options, right? You sell call, you sell put. And if the price does not touch or go way beyond the strike price, which means that your option expire worthless, then you actually keep to pocket the premiums, right? So you will build your capital, you'll build the premiums as savings as time goes by. That was how my winning streak became quite fruitful ever since August last year. And market was always on a bull run. I was just writing out the money puts, right? Because the market's going to go up. I'm going to buy something that's way down there, and it shouldn't just suddenly collapse and trigger the options to be exercised. But things take a change. I think it was also on the top of my portfolio where, NAV was growing because all the tech stocks were going up. So my portfolio was growing. So automatically, you will be reminded every time when you log in your account, okay, this is the amount of margin that you are able to use because of your portfolio size. And in the event of a sudden correction, it wouldn't be a collapse. I think this happened in April, where most of the tech stocks or chip stocks, they experienced sentimental sell down because results were not as flowery or were not as prospectful as what the analysts or Wall Street's estimates were. So there were brief sell downs, and I think when that sell down actually happened, first, your options, which were way below the money, you have a mark-to-market loss, right? Because it becomes more and more in the money, not yet in the money, but because of the mark-to-market, you're experiencing some sort of floating losses. And the second part of it, because of your collateral, which is your portfolio, the valuation drop, then you could also potentially, trigger additional stances from the service provider, like, okay, I think your portfolio has dropped in terms of valuation. You do not deserve this much in terms of margin. So there will be potential margin costs that you need to service depending on your service provider. That is the dangers or I would say the fears that you need to take note of, even if you want to, look into doing options strategy.
So your strategy, right? Can we take a step back to understand? You said you sell some put options, and that was your strategy, right? You hope that the price, even if it drop, doesn't cross over the strike price. So you just want to earn the premiums, okay? Small, okay. Then you did that, and let's say, right, what was your risk strategy when you are doing that? If let's say it really dropped, do you already have cash set aside, cash secured put, and just take over the shares, or do you actually think that if it dropped below the strike price, you just close the positions with a loss? So what kind of strategy that you're having? Is it some sort of like a wheeling strategy, or not so much on that?
I think it depends on different types of companies. So companies that you think I think had some sort of fundamental reasons to hold, definitely I'm more than willing to use the margins to hold on to the shares and then wheel it accordingly if I get assigned to it. But if it's just purely a stock that has high IV riding on, the AI catalyst. So these are stocks that I don't think there's much fundamental reasons to be holding it from a fundamental point of view. It's doing something, but it's not something life-changing or groundbreaking. Yeah, if it does goes against the money, definitely more than happy to cut it out and not get assigned. So take the loss and continue to strategize accordingly. So both aspects are potential viable options.
Yeah. So you were in your post, you were sharing you made some losses, right? Because it went past the strike price and now it got delivered. So you have the shares now in your portfolio.
No, not really. So what happened was that due to the correction, some of the stocks that I had in my portfolio, they suffered some corrections and the margins threshold was actually triggered. So I lost back most of the option premiums I wrote. So the diligent process of, saving and collecting premiums. So everything was lost back because I wanted to close out the options. So you sell it for cheap, but since it becomes more valuable and you don't want to have the stock in your portfolio, you need to buy back, you need to close the position, and you're actually going to blocking out more than you receive, and that is where the losses in terms of buying back comes to play.
It's typical case of margin caught, and then the brokerage help you sell the positions or close the positions.
It's a manual process, so you need to manually. So after that incident, only I know that for my brokerage, they will not force sell or close your options, but they will actually sell your stocks if you triggered margin call. So there is no window for you to top up cash. They are very strict on that. And I think I actually paid back most of the option premiums that I earned to close the options position. And then there was also a little bit of collateral loss from being forced to sell certain shares.
So after this episode, right, what was the main takeaway? Do you stop doing this, or do you think that this is just part and parcel of the strategy? So it's fine as long as you can earn it back later. So where do you stand now?
I think I lean towards the fact that I wouldn't know that when major market correction will happen, right? And due to the fact that my portfolio, the margining requirements is based on the valuation of my stocks. So the understanding is that if your portfolio is going to be worth less on a particular day due to market sell-offs, automatically the margin requirements will also become very skinny, right? So it will just depending on how much value your portfolio holds. And if you are, over leveraging by writing more options than your portfolio can take it, then you would face the risk of, getting everything liquidated in the event of a black swan event. So that is something that I think I need to be mindful of. I think a lot of people who are doing it need to be mindful of. So if it's a portfolio that is just sitting on cash, then I think you'll be less concerned if the options that you write becomes deeply in the money, and you have a cash secured portfolio. But if it's stocks where the valuation goes up and down every day, I think you need to think twice on your risk management approach before you even deploy any sort of option strategies.
Yeah, that's very true. Thanks a lot for sharing this. Because actually recently there's someone new came into my chat group and asked about can someone tell me how to understand the margin requirement? Then I was like, okay. And he's quite specific. He mentioned about IBKR. So I posted a couple of links about the margin requirement. Actually, I read some of those margin requirements because in the past I also have options positions, and I found this entire calculation is quite complicated. At the same time, they change all this ratio from time to time. And then at the same time, like you said, your own holdings, which should serve as a collateral, also changes. There are so many changes happen together, especially during stress environment. You don't know where's your position. Like you go and sleep, maybe after you wake up, the whole portfolio is already gone in the case of those intraday kind of shocks, right? Who knows, right? So I was like, okay. Then there's some discussion in the group. People are telling him like, okay, the best way to learn is just to try out yourself until you got margin call, then you will understand. I mean, okay, good advice, but who want to lose money first to go and learn these kind of things? But it's also quite hard to tell people that, okay, there are things that you may overlook even after you do this for like you say, a few 9 months, 2 years down the road, you just haven't experienced that kind of shock. One day it just the extra big one come, then also get hit, right? So I think that's the part that's not so easy to teach. Like you can teach people the dynamics, like what happened if it dropped below the put, what happened if the basic of the margin. But the unknown part is the part that we can't cover, 200 scenarios out there, right?
Yes.
Yeah, that's the challenging part. But you went through the learnings yourself. I think that's the best part. Now you have the experience.
Yes. So yeah, it really is not an easy feeling to digest. And I think it could be a make or break situation or event for someone. So some people, when they just see that, they'll just say, okay, I'm not going to be touching either derivatives or even going to stock investing, because it would just totally break them. I'm thankful that 1 month after that event, I think I still have passion and interest in the financial markets. So yeah, thankfully it did make me became stronger.
More resilient.
Yeah, more resilient. I think it becomes a test, right? So if you are broken by it, then you decided to stop doing stock analysis and investing, then probably you don't love it that much. After it happens and you still have passion, you still want to spend time, effort looking at something that most people think is a homework or a very tough assignment, then I think it just adds on to it. I say, okay, you really do love this, I really do like this, and it just proves to you that you should keep doing it until you see the results you want to see.
Okay, I think thanks a lot for all these sharings. Any last words or any closing statement you want to give for those who are still learning on this investing journey?
I think it's very important to know what you want when you retire, because I would assume that most of us invest to achieve some sort of financial freedom or stability in the time that we want. So try to do that kind of exercise, which is, I want to have this amount by age X or Y. Right now I have this much, and if I were to choose to do passive investing, because the returns, there's a historical return to it. So with this ETF, with this index, every month I put in this much, compound it, and by the age I reach 50, 60 or etc., how much will I have? If I'm happy with that, if it hits my retirement goals and requirements, by all means, you have already found your roadmap to to retirement. But if not, I think you really need to think of what to do now, because time is essence, time is money. And so long if you still have time, you still have choices, you still have time to learn, you still have time to look into things that you might not know yet, but you will come across opportunities that you might think that, hey, this is something that I'm interested in. I'm willing to spend time, effort to upskill myself. I want to do DIY investing. I want to do stock picking, because I think the results and the potential returns outweighs the passive investing kind of returns. So if you still have time to do it now. Don't postpone it and reach a certain stage where, oh no, I don't have time to get what I want for my retirement. And I think secondly is not just look at how much you can get, but also the potential pitfalls, because at the end of the day, risk and reward comes hand in hand. The more risk you are taking for more returns also means that there's more potential downfalls and pitfalls as well. Take that into consideration, plan your finances accordingly. Each and everyone have their own scenarios, predicaments they need to take note with. So long if you put in time and effort to plan out everything, and you have a strategy, you have a roadmap to follow, then just follow accordingly. I'm not here to tell you to only do stock picking and not do passive investing. It will just suits different people's portfolio and different people's appetite. By the end of the day, we hope that everyone can come to an age that, okay, this is the age I want to retire, this is the amount I have, I'm happy to spend the happiest moments of your life while you decided to pass on by the time comes.
Okay, thank you so much for all the advice. And for those who want to follow you, you want to give some shout out to your channel, to your blog.
All right, so if you are interested, go deeper down the rabbit hole of investing, you can come across my website at MyKayaPlus.com. You can also find me on YouTube. We do try to keep our topics as broad based as possible. So you also find very basic stuffs on financial planning, or we are trying to do more of that. And if you want more deep dive kind of content, you can also find me on my Substack. So I think that's more about it. That's mostly about it. Yeah. Right, feel free to also leave comments and suggest topics. So that would also give me an idea of what to write and what to advise as well.
All right. Thank you so much.
Thank you.
Thank you.